Good morning. My name is Brad Hall. I'm the managing director at Hall & Company, a CPA firm here in Irvine Spectrum. And I've been practicing as a CPA for about 33 years now. We handle pretty much the 5 to 50 million in annual revenue clientele.
Recently, you and Jim Schnell did a program as part of TCVN's ongoing series on corporate formation, and in that it was interesting to note that maybe C Corp isn't the best choice for a lot of businesses. Tell me about that a little bit.
Well, it's a very rare case when we will select C Corporation. Typically, publicly traded companies will be C Corps, but if you have less than 100 shareholders, you always want to be a S Corporation.
Okay.
Either an LLC or an S Corporation. I know that Jim somewhat is slanted towards LLC. I'm slanted more towards S Corporations because there's things that you can do with an S Corporation that you can't do with an LLC, and things that you can do with an LLC, but most of the time it's the S Corporation is the best entity of choice.
And so what would you say to a small company then that's just started up and they're looking at incorporating in another state, say Delaware or even Nevada?
Well, corporations have a lot of due diligence. So we always recommend that depending on the amount of due diligence that you want to be involved with, that you look at the other entity types, possibly a single member LLC. If there's only going to be one member, an owner, entrepreneur that's going to be forming the company, and an LLC works great. And then when you have more sophistication, a year later or 2 years, then you can incorporate the LLC with the tax-free incorporation. So it's always easier to move up into a more complicated entity structure than ever moving down, because you cannot move down from a corporation to an LLC.
We often hear about the phrase piercing the corporate veil, companies or individuals who want to protect themselves, their assets, their homes. Right. Are there any advantages with respect to those formations over each other, or do you still get the same type of protection afforded by an LLC or other entity?
That's the same coverage, same liability protection with an LLC as you do with either the C Corp or the S Corp. So liability is not a determining factor. It's really the complexity of how much of a burden do you want to be working on, filing forms, required payroll, processing, etc. Again, it's a much more difficult concept to do a corporation or a multi-member LLC than it is to do just a single-member LLC.
And indeed, with some of these formations, you get taxed twice versus once?
C Corporation is double taxation. So you have taxation at the corporate level as well as at the individual level when you do take distributions out. So, or if you sell the company. So C Corporations, again, are double taxed entities. That's the reason why they're so unpopular these days. LLC is pretty much a single taxation model. In California here we do have a what's called a gross receipts test or gross receipts tax that runs upward of $11,000 a year, depending on if you're over gross receipts of $5 million. But a corporation, S Corporation, only has California tax, and that tax rate is 1.5%. So, and that's on net income, not on gross receipts. So, again, that's the reason why I like S Corps versus LLCs.
Great, and there are also ramifications with respect to foreign control over your corporation if you've got someone who lives in another country or is a national of another country. Can you talk about that a little?
Sure. If you are a S Corporation or you want to be an S Corporation, you cannot have foreign residents as shareholders. Now you can have resident aliens, which basically if you have a foreigner that lives in the U.S. and has a social security number, they are eligible to be an S corporate shareholder. However, if you have a non-resident alien, that prohibits your use of an S corporation.
One of the other topics that had come up was the issue of being duly formed, and that is having the proper amount of funding in your corporation to get started, and then having the right measures in place to be able to protect yourself. Can you talk about that a little bit?
There's what's called thin capitalization. Jim and I spoke about that at the last workshop, and unfortunately a lot of times when entrepreneurs are forming their initial entity, they put in too little capital for the actual proper funding of their
And the ramification of that is that if you're not duly formed,
you have no corporate protection.
Gotcha. Okay.
Probably the biggest challenge we have is we get a new client in here that is a C corporation, and they have substantial value to their intangible assets, their goodwill, their business model, and they invariably realize that if they are to sell the company, that they're going to pay, 10, 20, $30 million in additional taxes that they wouldn't otherwise have paid had they initially formed as a S corporation or as an LLC. And I don't want to say that that's a monthly occurrence around here, that we do get a new client that has that problem, but I would say that it's quite a few times a year, and it is a very difficult process. It actually is a 10-year process to get them out of having to pay that extra tax, that double taxation on a sale of the business. And it actually holds up the sales. So, someone comes in and says, hey, we want to sell our company, and then we let them know that their overall total tax will be pushing about 70% of their sales price. And then they realize that they're not going to settle for a 30% net on the sale price. Therefore, they come to us and say, what do we do? And we let them know that they can convert, but there is going to be a 10-year process from the date of the conversion. Well, with regards to when the typical client should engage a CPA, they should do it from the time when they initially form. And there should be more emphasis on the formation process. And they should not just strictly take their business attorney's advice or the advice of their neighbor. They really need to look at the proper entity choice, and that starts with having a good tax CPA. And CPAs come in all different types. There's auditors, there's tax specialists, and they really need to speak with a tax expert. Invariably, a client will go to an H&R Block, or they'll go to a cheap provider that, unfortunately, with the complicated issues that they have, they really need to go to a sophisticated CPA. So invariably, they have made elections that the wrong elections, or they haven't made the elections at all, or they've selected the wrong fiscal year end, or the wrong accounting method, and then they come here, and then we have to spend a lot of time and effort to try and put them back into the right program, the right status, the right entity type. I would say the thing that has changed since I initially got into it 33 years ago is that the tax code was about an inch thick. Now it's multiple volumes, and it takes a lot of work to be able to keep up because the tax codes are changing so rapidly. And the rules and the tax court cases, everything has to be, it's constantly moving. So it takes us being on top of the tax code and all the rules and regulations almost on a daily basis. What I like about public accounting is the fact that we can help so many clients in every business. Yesterday I was with a optometrist, and they had hired a tax provider down in Texas that had set them up in multiple LLCs. And now we're having to go back and merge all the entities together, and it's going to cost them thousands and thousands of dollars to merge these entities into one entity, so that they don't have multiple filings. And there's so much complications with that. But again, I love it because we're able to fix and assist and reduce the pain associated with taxes and tax planning for clients.